Good afternoon, ladies and gentlemen. This is Tseng, Senior Business Management from Mysteel Global. Today, I'm going to share some use cases of how Mysteel data are applied by hedge fund traders and analysts. First off, Mysteel is in the commodity data business. As you can see on deck 2, commodity and futures are inseparable in China. We have over 100 commodity futures and options listed here, both deep and broad. But just 9 index and bonds contracts. The proportion is the exact opposite structure to Western markets where index, equity, rates, and currency derivatives are dominant. Since the Chinese yuan, CNY, is a control currency, we don't expect to see a currency futures in China for the foreseeable future. Hong Kong being a different system, of course. In a conservative and retail-driven market, short selling are seldom encouraged. Stocks are much harder to borrow in China, so we can rule out any possibility for single stock futures or single stock options for now. However, the government had always been more supportive in creating a vibrant commodity futures market. There were a series of historical events that shaped this phenomena, and let's go over some of them. A few years after our former leader Deng Xiaoping's iconic Southern Tour, China's economy began to open up. China, in fact, launched a bond futures in the early 1990s, but it ended up spinning out of control. A series of 3-year treasury bond futures was known as 327. The chairman of China's most powerful brokerage house at the time reasoned that this bond was overvalued based on the coupon rate and the interest rate environment at the time. So he led a syndicate of investors and began shorting the bond futures heavily. As it turned out, another company owned by the Chinese government, the Chinese Ministry of Finance, was building a long position, and later a subsidy was announced on the 327 bond out of nowhere, and future prices continued to rise against conventional wisdom. The syndicate got caught short in losses and also desperate. They pulled off a stunt and tried to corner the market on the close of February 23rd by shorting 10.5 million contracts in the last 8 minutes. That's that last spike to the right of the deck. You see volume rose by from 1 million to 12 million. It was all done by the same syndicate. These trades were worth 30 billion USD. China's GDP at the time was only 600 billion. To give you an idea how much things cost in the era, an apartment in Shanghai only costs 30,000 USD, and it's like 1 million or more now easily. Although these trades were later rolled back, the event was a catastrophe to the market. We will not see another bond futures trading in China for the next 2 decades. Fast forward to 2010, CSI 300 index future went live. It's a Bahama index comprised of 300 large cap stocks in China. The contract quickly became the prime time of speculation during the bull market. Its volume surpassed S&P 500 E-mini at one point, averaging 2.2 million contracts per day. Retail investors like the moms and the pops that couldn't afford to put up enough margin deposit also joined the scene. How? There was something called index future arcade that appeared all over China like Pokemon. They were equivalent to the bucket shop in the early 20th century Wall Street. Instead of posting full margin for a real contract of CSI 300 futures, the arcades only require 0.2 or 3% of margin. So you would lose all your money in a matter of 2 or 3 ticks. Obviously, these orders were never meant to be routed to the exchange. You're actually betting against an illegal underground casino at your own risk. But nobody cared because it was the bull market. When the equity bubble finally busted, CSI 300 received all the blame for bringing down the market. Regulators then imposed insanely high day trading tax, very rigorous position limit, and short selling restriction. Commission to trade the CSI 300 rose by 1,000, so tenfold, 1,000% overnight. And overnight, CSI 300 went from hero to zero. 99% of the volume evaporated. Although this contract is still trading today, it's never the same. And China Financial Future Exchange, where the CSI 300 is listed, also happens to be the only exchange that hadn't been approved for international trading. And that says a lot about China's stance on financial derivatives. In the old days, before our regulatory framework was fully mature, China had 400 to 500 future brokers and more than 50 future exchanges trading commodities like watermelon, sesame, red bean, potato, eggs, anything you want to eat, you can trade it. In a bloody trading episode, coffee bean came into the spotlight. Shortly after Hainan Exchange launched a coffee contract, it was trading with breathtaking volatility. Between 1996 to 97, it traded in the range of 9 CNY per kilogram to 42 CNY per kilogram. That's 400% top to bottom, completely decoupled from NIBOT, the New York Board of Trade coffee contract. It once traded 10 limit up in 12 sessions. A group of speculators engineer a short squeeze, try to force the market to go up, and it later reversed its position to short the market by importing 17 million kilograms of coffee bean for delivery. In January 1997, the event culminated in a dramatic fashion. The short side had won by landslide. Open interest of the coffee contract doubled, tripled, quadrupled, and quickly maxed out the exchange limit. There was no way to resume trading because the long maxed out the exchange. The exchange tried to negotiate an early settlement to prevent price from dropping further, but it didn't work very well. Trading halted. The exchange was later dissolved. Regulators' interpretation on this event is that futures market should serve the real economy, meaning the spot market, actual physical demand and supply. Well, Chinese hardly drink coffee. The average Chinese drink just 6 cups of coffee a year. So why are we trading coffee as a commodity? From then on, the exchanges would prioritize commodities that we actually consume. After 2 decades of reform, we now have a sound financial system in China. When QFI, Qualified Foreign Investor, was introduced, first introduced in 2003, yes. Foreign institutions had to qualify for many criteria to access China and invest. The firm, the QFI, must be a large bank, pension fund, or asset manager with a minimum AUM threshold, and QFI could only go long stocks. Things have changed in the recent year with futures exchange opening up gradually. With the removal of quota and easing of investment scope, we now see big names, hedge funds, and high-frequency trading firms setting up offices and hiring in China, in Shanghai, or Shanghai, Beijing. For the most part of Mysteel's corporate history, we sell data to domestic steel makers and commodity brokers. I say 50 to 65% of these firms are our client. From the time I joined Mysteel till today, things have changed. Our QFI client portfolio kept growing. We now work with around 3 dozen of QFI from overseas. A bit more background on Mysteel. We're the oldest, probably the most recognizable name in China's commodity data industry. Also, the only publicly traded one on Shenzhen Stock Exchange. Originally, Mysteel, as the name states, was all about finished steel and raw material data, like iron ore, coal, coke. But we began to diversify into base metal, petrochem, and agriculture through rounds of hiring and a couple acquisitions. Mysteel indices are widely adopted in China's physical trading. More than 85% of the physical steel trades use Mysteel as a reference price to place in their contract. And we were the first ICE code compliant firm. I'm personally based in our Shanghai headquarters, but we have about 2,000 staff here alone, and there are 30 more regional offices spreading across China. And we have teams in Singapore, Hong Kong, UK, and Australia. Besides data, Mysteel also operates Bank Steel, an e-commerce platform that trades physical steel. It turned over 300 billion USD last year. Huge volume. And we do have a future brokerage arm in Singapore called Mysteel Commodity Broker, which is one of the largest trader on Singapore exchange. So what does Mysteel really provide? The first and foremost data I like to cover is weekly red bar consumption. Red bar is known as the construction steel. It's the single largest finished steel product. Therefore, it's traded on Shanghai Futures Exchange. 65% of the red bar is used in building homes and property. And a good portion of it is used in building highway, railroad, airport, and etc. I mean, real estate is huge in China. Most of you probably have heard of Evergrande liquidity crunch in 2021, the large real estate developer. China built new homes at the rate of 12.36 apartments per minute last year. Some statistic even shows that 70% of China's family wealth is tied up in real estate. Our entire life, from birth to marriage to raising a child, revolves around home price. Housing is the heart of our economic growth. Any slowdown in red bar consumption translates into a China slowdown. Our hedge fund clients analyze this data not only to trade red bar futures, but also to put on other real estate, infrastructure, and macro trades across different markets. Well, we cannot discuss China commodities without first mentioning iron ore. It's also Mysteel's strong suit. So I titled the next two slides, Game of Ores, dedicated to Game of Thrones. Iron ore is the undisputed king of dry bulk commodity. It's the second largest commodity trade on earth. It's also China's third most imported goods, just behind semiconductor and crude oil. It's easily an annual $100 billion USD trade, depending on the current market price. Not surprising at all, DCE iron ore future is the most successful China futures contracts to go global. Simply put, the iron ore trade is about Australia and Brazil, where the world's big four iron ore miners are situated. They are the largest supplier. China is the largest consumer. Mysteel tracks iron ore arrival at 45 China ports with granular detail. By that, I mean we can track over 90% of the iron ores that arrive in various China ports, Tianjin Port, Rizhao Port, you name it, each week. Broken down by types such as fines, lumps, pellets, by grades, from low end to high end, 56% Fe to 66% Fe, or by region, Australia, Brazil, India, even by each vessel to some level. Mysteel iron ore data isn't just an indication of demand and supply. It also provides other trading opportunity. where you can trade the low-end grades against the high-end grades between DCE and Singapore Exchange, because there are multiple iron ore contracts listed in Singapore. And calendar spread, where you spread between the front and back month contract based on Mysteel Portside Index and Mysteel Seaborne Index. They have different lead time. One is the future price, one is the current price by the port. Hedge fund use Mysteel iron ore data to express views on currency, mining, and shipping sector. This commodity affects CNY, Australia dollar, mining stocks, and shipping stocks. Because iron ore is the largest dry bulk commodity shipped seaborne, is greatly tied to the freight market as well. On to season 2 of Game of Ores. After iron ores are shipped and unloaded in China, they're transported to steel makers and get placed in a blast furnace. BF is a vertical tower, the one where you mix iron ore, coke, and other refractory to turn it into pig iron. Mysteel tracks the operation of 700 plus BF from 247 China steel makers, which represents very close to 95% of all onshore capacity. When our chief representative in Japan, Mr. Asada-san, came on board, with 30 years of steel trading experience, he was still mesmerized about how Mysteel is able to track steel makers down to each blast furnace. It's unheard of in Japan, at least. The weekly BF capacity rate is the body temperature of China's steel industry. Whenever we run into a long holiday in China, a policy change in China, equipment maintenance or supply shortage in China, the weekly number fluctuates. It led to many turning points in the commodity cycle. But since this reflects mid to long-term trends, let's try something more interesting by adding Mysteel Bullish Sentiment Index to this chart. Similar to Purchasing Managers Index, the PMI, Mysteel surveys a sample of domestic producer and traders each week on how bullish they are on this market on the scale 1 to 100. Sure, there's a lot of noise in this number because the crowds could get emotional. It's a survey, after all. But by combining a solid fundamental indicator in Mysteel BF capacity and a short-term sentiment index, you can capture an entirely new view on this market. Before we start on this slide, I must point out that every piece of Mysteel data is the result of in-house price assessment, because we get that question a lot from clients' compliance department. Mysteel published its major weekly numbers on the website in the following day, but for premium subscribers, we send out the numbers through email instantaneously. The Big Five trading market, the Big Five capacity utilization, blast furnace operation, portside stocks, coking plant profits, construction steel trading volume. What you see on the slide is not a complete list, by the way. What we refer to as the Big Five are red bar, HRC, CRC, steel plates, and wire rod. In essence, these are the only 5 finished steel products you need to know. And most of them have a corresponding futures contracts listed in China. On DCE and Shanghai Futures Exchange. I often call this service as trade alert. These data are guarded with a high level of secrecy prior to release. I myself don't even have access to these data, although my clients are subscribing. Hedge fund traders and commodity trading desk put on short-term directional trades when they receive this trade alert. And it's market moving on many occasions, or else they wouldn't pay for the data. Let's change the flavor here and discuss something edible. Soybean oil and palm oil are the most common vegetable oil. The former is primarily produced in the America, both North and South. The latter is primarily produced in Southeast Asia. Soybean oil has healthier unsaturated fat, so it historically trades at a premium to palm oil. But personally, I like olive oil better. What caught traders off guard was the Russia and Ukraine conflict and Indonesia export policy change last year. It turned into a global food supply shortage. As the palm oil futures was making all-time high on China's DCE exchange and Malaysia's BMD board, the soybean oil and palm oil spread on the spot market was approaching uncharted territory. Yeah, it used to average around 500 CNY. But it deteriorated and hit an all-time low of negative 4,370 CNY. That's a big swing. Some of the blogs and columns I have read suggested the spread may never narrow. They say this time is different. Don't fight the trend. Here's the thing though, unlike stocks that can trade on forward expectation, palm oil requires harvesting, logistic, and refining. It has a crop cycle, and we actually eat it. So inventory in agriculture is like the law of gravity. It can neither be created nor be destroyed. So you have to respect the inventory number. Mysteel tracks 21 refinery in 6 major China province. That's roughly 70% of all the onshore production. Palm oil commercial inventory had long been depleting before soybean oil and palm oil, before they even reached parity. And it hit an 8-year low at 200,000 metric ton. You saw how, you can see how low the inventory was to right-hand side. These two products are often mentioned in the same sentences because they are highly substitutable. Would you swap palm oil for soybean at that extreme level? Would you want to buy low and sell high, or buy high and sell low? It's a judgment call, but in this instance, the spread narrows shortly and reverse its course from negative 4,600 to around positive 2,000 Chinese yuan by the end of 2022. Last but not the least, I like to highlight the importance of physical delivery. There's a significant relationship between smelting profit, inventory, and basis. The basis being a premium or a discount between futures and spot. When aluminum smelters have a large profit margin, they ramp up the production to meet demand, which leads to inventory buildup. So you can see the red line and the blue line are inverse. Traders follow the level of exchange warehouse receipts closely, especially when we get close to expiration date. There are warehouse receipts are the documents that guarantee quantity of commodities available for delivery in the approved exchange approved warehouses. More sellers will be willing to go into delivery when futures is trading at premium. Less sellers will be willing to go into delivery when future is trading at discount. In that case, they might just cancel their warehouse receipt because they don't want to sell at a loss. Social inventory is a reserve pool that may be converted into warehouse receipts whenever supply is needed. So it's an equilibrium mechanism that keeps the market in balance. Smelting profit, inventory, basis form an interplay in trading. You cannot overlook spouting profit, even if you were a short-term trader, momentum trader, or technical traders, because the law of demand and supply is always in force when this market is physically settled. The China futures market used to be isolated. It gaps up or down on the open to catch up with overnight moves in Chicago, New York, or London, but not always. 5 years ago, there was only one contract that a foreigner could effectively trade, the INE crude, and DCE iron ore contracts soon followed. Now QFIs can trade more than 40 commodity futures and options. It's quite a breakthrough. Some of the competing exchanges on competing contracts on the global exchanges don't come anywhere close in terms of volume. I can easily name 15 commodities that trade over 1 million contracts a day in China. That's not common overseas. This market provides blocks of liquidity needed for cross-border arbitrage, whether you want to trade Shanghai against London, or DCE against Singapore, or ZCE against Intercontinental Exchange, the ICE. Now is a good time to participate because many restrictions to access China have been lifted. Last year, Mysteel collaborated with Singapore Exchange and licensed our red bar US dollar index. So there's a contract as such. It's available for trading on Singapore Exchange now, which provides another trade link between Shanghai RMB red bar and Singapore USD red bar. These are future contracts. They are live. By now, you may wonder how Mysteel compiles data that we previously went over. Put it in simple terms, Mysteel's unique strength lies in its first mover advantage and industry position. Our company was founded in 1999, long before China was the dominant steel producer. By now, with rock solid working relationship with 300 steel makers, 300 mine operations, 45 ports, and 150 warehouses. China's National Bureau of Statistics is also our partner. We get visited by association, government agency, foreign commodity producer, and analysts on a daily basis. Yeah, I came back to China in the year of 2009. People frequently told me, you know, things work differently in China. It's not about what you know, but who you know. As I got older, I understood this reality. Information does not always travel in a systematic way in China. And that's Mysteel's advantage, a established network within the commodity supply chain and the whole ecosystem. All good time must come to an end. My session today is over. Thank you all for coming. If you'd like to connect with me directly, there's my linking QR code to the left. And for other business inquiry, there's a QR code to the right that you can scan. It's truly an honor to be here today. Thank you all again.